All right. Welcome to our session today. Is Wednesday, September 7th. This is the 11 a.m. section. We're recording this as a live Zoom for everybody that's watching on video today. As I said, hopefully next week we'll get back in the classroom for live sessions. Again, sorry about my continued health challenges, but hopefully it's not slowing us down on anything we are going to cover. So today I want to focus on really two things. One, just briefly cover the solution to homework 1, and 2, set you up for homework 2, which is the topic will be EIC, will be our first kind of major section of our course. I also want to point out, so go ahead and share my screen. That you have been assigned to teams. So in the people section, these, click on the teams tab, these are the teams that you're in. So the group projects are going to begin on Monday. The first one will be the Bloomberg Trading Challenge. And so between now and Monday, you need to kind of meet your team members. So if you just click on this, you can see, like, for example, who's on your team. So start contacting them. And between now and Monday, you need to select essentially a team captain who will be your representative for the Bloomberg Trading Challenge. So only one member of your team will be able to access the trading challenge and trade on behalf of your entire team. So it's a group project. The team has to talk together about which stocks you want to invest in. But ultimately, you're going to have one person who's going to do all the trades. And they're going to be very important because they're going to trade on behalf of the group. And your group's performance of the Bloomberg Trading Challenge is going to be based on how you perform over 6 weeks. So if they don't do what they're supposed to do, it could really hurt your team's grade. Or if they go rogue and start making a bunch of trades your team didn't talk about, then that could also hurt your group's grade. So very important that you identify this responsible party who will be trading on behalf of your group for a group grade. And again, there will be peer reviews on all of these grading projects this semester so that this person's not doing all the work and everyone needs to be participating in the trading challenge as well as all the other group projects. Otherwise, you won't get credit for these team grades. Okay. So again, your first group project starts on Monday and the other one's coming up later in September. So you got to make sure that you start meeting your team members. So this is where you'll see your team members. Okay. All right. So again, between now and Monday, identify a responsible party for the Bloomberg Trading Challenge. And I'll give a quick preview of what that's going to be about later in our session. All right. But as I said today, when we go back to assignments, your first homework was due this morning. That was homework 1. And your second homework is due on Monday by 8 a.m. Okay. Both of these will involve Bloomberg. So hopefully you've gotten your Bloomberg terminal licenses and you have started on your BMC certification, because that's also going to be due the end of next week. It's going to come up very quickly. Right. So again, for homework 1, very simple assignment. You had to take a screenshot and basically give me an industry that was a negative spread. Sorry, that's right there. Okay, based on latest filing. So there could have been many industries that you could have picked, including ones we covered in class on that first opening video. But basically, you would have gone to Bloomberg and you would have gone to a company. I'm on Merck. Go to RV, go to custom, and created a template based on ROIC of latest filing. And then you would have also typed in WAC, and preferably you would have saved this template, making sure market cap weighted average was across the top. There's my save template. And essentially you'd have tried to find an industry with a negative spread based on market cap weighted average. Now, Merck is clearly not in that industry. The pharmaceutical industry is a very attractive industry, creating a lot of value. So this is a positive spread. There's an ROIC and WACC, right? So this wouldn't have worked. But if I looked for an industry that has a negative WACC, I could have taken, for example, Ford or automobile companies. I believe they have a negative spread right now. Give it a second to load. So industry with a negative spread, ROIC less than WACC. I could have taken airlines. Here's like Delta Airlines. So there's lots of industries that have negative spreads. I'm picking companies. Now, if you had done your Bloomberg certification, one of the other areas of the terminal you would have learned about is something called the equity screening tool. This is one of the most powerful features of the terminal. And what it allows you to do is literally screen their 1.6 million securities in the database against any criteria that you want to figure out which stocks meet that criteria. So what you could have said is, take, for example, criteria SPX, which is the S&P 500 index. So that would basically narrow this down to the 500 companies, the S&P 500 index. And you would say, gee, that says 503. Why does it say 500? Because we have 3 dual listed stocks. So for example, Google has a Class A share and a Class C share. And so they're in this S&P 500 twice as one company. For Alphabet, 2 stocks, symbols for the same company. Anyhow, 3 cross-listed stocks or double dual listed stocks, dual listed classes. So there's the S&P 500. And then you could have said, show me ROIC screening criteria. And then you could have said less than, I don't know, 8%. There's 189 companies, the S&P, that have an ROIC greater than 8%. And then we could have added a screening criteria and a WACC greater than 8%. So essentially 41 companies in the S&P 500 that essentially have a negative spread of less than 8%. Okay, these are and criteria that you go through. So you come down to the bottom, and then you could hit see results, and then it'll give you those company names. Okay, so that's the other thing. Like if you couldn't have figured out individual companies by guessing them, you can actually do a screening to see who has negative spread by using the screening criteria. Right. So back to, you probably didn't do this for equity screening tool, but I want to make you aware of this because when you start your Bloomberg Trading Challenge, this is another way that you can start getting information, insights into companies based on historical data that will help you filter out selection criteria. EQS is how you get here. Questions about equity screening? All right. So let's say that we had taken, and I'll go back to the airlines. Delta, RV, custom, show my negative spread. Then once I have my negative spread for my industry, based on market cap weighted average, I will just load the template again. I come up here, take a screenshot, save the file, put it on a hard drive as a GIF file to submit. Okay. And again, save it to a thumb drive if you're on the terminal, or email to yourself and then send it out. 2 elms. But again, this is what you would have had to do to get easy 2 points for homework 2 or homework 1. All right, so that was homework 1. Questions about homework 1? All right, let's talk about homework 2, which is going to be based on EIC. So I posted under files a lecture note, and this is lecture note 2 that we're about to cover here. So EIC, it's a framework where E stands for economy, I stands for industry, C stands for company, and it's a way of explaining how the external market impacts a company or industry. Okay. So again, approximately 50% of the performance of any company is based on the industry that it was in. So you saw that in some of the data we did in homework 1, meaning if an industry is performing poorly, airlines, it's hard for any of those airlines in that industry to do well, right? If an industry is doing really well, industry coming up Qualcomm for your next assignment, then you'll see most of the chip makers are actually doing pretty well. Industry matters. That's the key in the EIC framework. So the point is, how does the macro environment affect an industry? That's the economy. What is the industry structure and what does that mean to industry profitability? How's that going to change over time? That's the I in the EIC. And then C, does the company have a competitive advantage? Are they going to do better than their peers? So that is the EIC framework that we are going to be using to communicate performance today, to explain the industry performance and performance over time. And in today's world, the economy starts to have even more of an impact, right? Because we're now dealing with a hyperinflation environment in some companies and some countries. We're also dealing with some negative GDPs. So ultimately, in today's world, changes in the economy have even more of an impact than they did, for example, 6 months ago, to what's going to impact to the companies. So EIC is the framework. So the first part we're going to talk about is E, economic analysis. And when we do economic analysis, we're going to try and answer 2 questions. Question 1, what's going on with the economy and how are those macroeconomic factors affecting the industry? And then 2, how is the company that I'm analyzing being impacted by those economic factors? So basically, do they matter, right? So is the economy getting better or worse? And does the change in the economy affect the company and the industry that I am evaluating? Okay, so those are the 2 questions that we are going to try and answer for economic analysis. So where do we start? Well, for economic analysis, we're going to start with Bloomberg. So going to our tool, a few screens on Bloomberg you should be aware of. One of them is called ECFC, stands for Economic Forecasts. So it will default to the US, but you can choose and switch to any company, any country, but it basically gives a summary of economic data, past and future, starting with GDP. And as I scroll down here, CPI, housing market, labor market, current account balances, interest rate forecasts, major exchange rate forecasts. Over here on the right, probability of recession in the next year, obviously in the US, very high at 50%. And you can see we're seeing much more tepid growth in the next few years expected going forward after a strong growth in 2021, recovering from COVID. But the point is, we can actually look at economic forecasts. And the way these forecasts of GDP in 2022 are coming up, click on it for transparency, is that Bloomberg is surveying 63 economists, okay, from all these different institutions. All of them have their forecast for GDP. Bloomberg then aggregates and averages them, and then the average forecast of all the economists basically becomes the forecast for GDP. Okay, so essentially, we get a sense that there are going to be some challenging times in the economy in 2022, mainly because of a cutback in government spending. Okay, that's hurting GDP. So ultimately, when we look at this, the question is, what's going to happen in the economy? Get a sense of the economy. We look at different regions of the economies around the world. The other thing that we're going to look at is something called ECSU, which is the Economic Surprise Index. So going back to the Great Recession of 2009, 2010, we had a big housing crisis back then. Bloomberg started tracking the data over here on the right. And what they did is they aggregated, you can see it over here, 42 economic indicators, which they put into 6 categories or 6 buckets, okay? And then they said, let's track how each of these indicators perform and what the market reaction is when the data is released. And so the idea is a rising tide should rise all boats. So if we have a better economy, there's more money out there and companies should generally be doing better. If we have a worse economy, there's less money out there and therefore companies should generally be doing worse. And so the question is, how do the companies react to changes in the economy? And that's where they started creating the surprise monitor. So what they did is 2 things. One, they created an index of these 42 factors in 6 buckets to 1 index, and they called it the surprise index. And they basically plotted it and tracked it against changes in the S&P 500. So the idea was when data came out worse than expected, or these economic indicators, the stock market went down. When data came out better than expected for these economic indicators, stock market went up. And over time, they've seen a pretty good correlation between surprise direction in the economy and performance of the stock market. And so that's the point. If the market is unexpectedly better, then the market should do better. If the market is unexpectedly worse, then the market should do worse. So as data comes out, how does it perform against expectation? And based on the recent data, these 4 buckets, housing, industrial, labor, and personal and household, have underperformed expectations. Retail and surveys have slightly overperformed expectations. Over here, if I want to see why has housing underperformed, these are the 6 indicators that Bloomberg is tracking for housing. Home sales, pending home sales, new home sales, existing home sales, housing starts, building permits, and overall housing market index. So here's the point. Home sales, new home sales, and existing home sales have been coming in worse than expected. So this is surprise against the estimate. All right. And then over here is what happened to the stock market before the data was released and what happened to the stock market after the data is released. Okay. So just to see whether that data moved the market. Okay. But overall, this is the story of surprise. So questions about the surprise index, how to interpret it, how to read it, what it means. And again, this should be covered in your Bloomberg BMC certification. All right, so then moving on. So back to your assignment, you need to talk about what's going to happen to the economy. And then you need to talk about what's going to happen to the company that you're analyzing. So for your homework assignment, you're going to be doing it on Qualcomm. Okay, so I'm not going to talk about Qualcomm here in the class today. But let's say that I was doing it on an automobile company like Ford. So I go to Ford, US equity, and I'm at the security. Okay. So first, what we're going to do is we're going to go to RV. Just as you did for your previous homework assignment. And then we're going to use a comp source. And the one that we're going to kind of default to is the Bloomberg best fit algorithm, or the analyst curated. Basically, who are the markets actually look at as Ford's peers. I'm in the global business. And then I'm going to go over here to the tab called markets. And then I'm going to go to the sub tab called beta. And so what it's going to show me is the industry beta, which is the raw beta, average of all the companies, and Ford's beta. And we're going to use beta as a proxy for economic sensitivity. Okay, because here's the point. If the market goes up when we have better economic news, then the S&P 500 should be pretty correlated with the market. So the question is, how correlated is an individual company with the S&P 500? So that if the market's going up or down based on economy going up or down, and if I'm correlated with the S&P, then I'm going to go up and down with the market / the economy, transitive property. Now, Ford and the automobile industry has a beta above 1. Now, what does a beta of 1.66 mean? So somebody on this call, give me an explanation for 1.66. What does that mean?
Doesn't reflect greater market volatility.
Okay. So if the S&P 500 goes up, what does a beta of 1.66 generally mean?
It's going to move in the same direction.
Not just move in the same direction. What else does it mean? There's one additional.
If the market moves 1%, then this will move up 1.66%.
Exactly. So it's going to go up much faster than the market. Now, a 1.66 beta also means that the market goes down 1%, then the stock's going to go down 1.66%. So a beta of 1 means you're going up and down exactly with the market. A beta above 1 means you're going up faster and down faster. A beta below 1 means you're going up slower, down slower. So if you think about economic sensitivity, if the auto industry is at 1.66, what does that mean to economic sensitivity? Is this industry more or less sensitive to changes in the market?
More.
Exactly. So therefore, when we think about the E, what happens macroeconomy is going to have a big impact on the automobile industry. Okay. And I only gave you 2 screens. There could be other things that affect the automobile industry. Another one right now might be the price of oil. Okay. Because obviously when oil prices are high, that will affect the type of cars that people buy. And to some degree, it might take away some of their disposable income and force whether they go to new cars or used cars. So the point of the story here is that this industry is pretty economically sensitive. So we very much care that there's changes happening out in the market. And we know that this market's going to go up or down faster. That's what the beta of 1.66 tells us. Now, Ford, if that's our company, we also know is not as sensitive as the average automobile company because their beta is only 1.39 and the average beta is 1.66. Okay. So in your write-up for your paper, what you would be saying is economic sensitivity of the auto industry, very sensitive. Economic sensitivity of Ford, not as sensitive as the industry, but still very sensitive to changes in economic conditions. Questions? Questions about that assessment, how we're making it, how we use it?
So when a beta is negative, it doesn't mean that the company is moving against the S&P.
Correct.
It doesn't mean that.
It means it's going the opposite direction.
Okay, never
If
mind.
it's negative beta, that means the market goes up, that company goes down.
Okay, thank you.
Now, ideally, that's what's called your hedge. All right, that's a perfect hedge. All right, because I want to hedge my losses. I want something when the market goes down, something that always goes up. All right, but the problem is that usually it's hard to find negative betas. So we usually find low correlation betas as hedges. But regardless, a negative would mean opposite directional. Matter of fact, I'm going to go to EQS here. I'm going to see if there's any companies in the S&P right now that have a negative beta. To answer your question, beta, and criteria, beta less than 0. And the answer is none. So that's the point. Like most companies don't have negative betas. They might have very low betas, but they don't typically have negative betas. But that's what we're starting to talk about for economic sensitivity. Now, one of the things I will mention though about your beta is going back to the RV screen for Ford markets. Beta is where you're getting this. Bloomberg calculates two betas. It calculates a raw beta and adjusted beta. Okay. Now, in the actual CAPM, it uses the adjusted beta for weighted average cost of capital. The difference between the two, you can see it right here, is the adjusted beta takes 2/3 of the raw and 1 and just does a weighted average. So it basically takes the raw beta and moves it 1/3 closer to the mean. So it's basically putting in a smoothing coefficient. Now, there's statistical arguments about whether you use adjusted or raw. For purposes of this class, we're going to use the raw. Okay, it's the actual slope of the trend line. So, matter of fact, if you want to see how Bloomberg estimates a beta, type in beta, and you'll see that it does it based on 2 years of default data. So, what it's going to do is it's going to take 2 years of, in this case, weekly changes in Ford share price. 2 years, weekly changes, the S&P 500 index, scatter plot diagram, trend line, slope of the trend line is the raw beta. Okay, so that's where the raw beta is coming from, 2-year trend line. And by the way, nice feature of the tool, if I need to adjust anything, I can do that. So for example, if I want to make this a 5-year beta versus a 2-year beta, I can do that. Doesn't change it that much, nonetheless. If I want to go from weekly to monthly or daily, I can change the scale. If I also want to regress this against not just the S&P 500, but let's say I want to address this against the Morgan Stanley World Index. That's the beta against the Morgan Stanley World Index of Ford, as opposed to the beta against the US stock market. So again, in the beta screen, I can do a lot of powerful stuff. But again, the default Bloomberg beta is 2 years, S&P 500 for US companies, and they use the adjusted in CAPM. We're going to use raw for purposes of this exercise. All right, questions about the E? All right, continuing on. Now we're going to go and we're going to talk about the I. The I in this conversation is the industry. Point of industry analysis is basically to explain the performance of the industry based on its actual results today. And we're going to use the 5 forces model of Michael Porter to explain the industry. But more importantly, we're also going to explain the changes in industry performance over time. So translation, what's the industry today? What's the industry going to be in 5 years? And secondly, we're going to have a very specific definition for industry attractiveness based on spread. Okay, so a positive industry attractiveness is a positive spread. A negative industry attractiveness is a negative spread. And then a break-even spread is a neutral industry. Okay, so spread equals industry attractiveness, and it's going to be the spread of the industry. Then we are going to use the 5 forces model of Michael Porter to explain that spread. So the key is, it's not just what you think the spread should be, it's you're explaining the spread that you see. Okay, and so this is being very careful to get your biases. So back to the 5 forces model, which you've done in previous classes, there's 5 forces: buyer power, supplier power, barriers to entry and exit, rivalry, substitutes. Those 5 forces, not necessarily all of them having the same weight, explain the attractiveness of the industry that you see. Okay, now a couple things to remind yourselves of. When we think about returns over time, one of the keys that you read in the book is that ROICs tend to regress to the mean over time. Revenue growth also tends to regress to the mean over time. Okay, so your bias should be that terrific performing industries today are much less likely to be terrific performing industries in 5 to 10 years. Ironically, poor performing industries today are much less likely to be poor performing in 5 to 10 years. I think it's not possible, but just the data suggests regression towards the mean, because the best industries tend to get more competitive. The worst industries tend to have disinvestment and basically forcing companies to try and get to better returns. Okay, so generally there's regression to the mean over time, but there can be exceptions, right? But regardless, we still have to explain what we see. So part of your homework assignment is going to be doing 2 things. 1, using the 5 forces, explaining the structure of the industry for the industry today and how that determines the industry spread today, and whether those forces are going to change over time. Because here's the point: if the forces don't change, then the industry spread should be about the same. If the forces get more favorable, then the industry spread should get better over time. And if the forces get more unfavorable, then the industry structure should get worse and the performance should get worse. So the point is, you need to explain the structure today, and you need to explain any change in that structure over the next 5 years and what its impact on spread will be. That is what's going to be part of your homework assignment. Okay, now how do we actually practically do this? So back to Bloomberg, using Ford as our working example. So we've done our E for Ford, and we found out that Ford is not as economically sensitive as the automobile industry, but they're both pretty sensitive when it comes to the economy. And we're using data in our answers, because that's another key in this class. If you don't use numbers, you will not get credit for an assignment. So if in your EIC assignment, you basically say the automobile industry is economically sensitive because it has a beta that's high, you're going to get a 0 for that assignment, no matter how many words you write. A correct answer in this class would be that the raw beta for Ford was 1.466. And that is the reason why it is economically sensitive, because the average industry beta for the S&P would be 1. Without numbers, no credit. That will be true for every assignment you do this semester, because otherwise, if you make general statements, we have no idea whether or not you're right or you're just guessing. So the only way that we know that you're right when you use your data is if you actually use data in your answers. You will be doing that consistently all this semester. So we've answered our E question and we've taken our E screenshots, which we will save so we can submit. No screenshots, no credit. Okay, you must submit screenshots in addition to your write-up to get credit for your assignments. No exceptions. If you submit a 500-word paper and you forget to put your screenshots, you're getting a 0 on that assignment. And I don't care how much effort you put in. Okay, so without the data, your answers are meaningless. Okay, you can submit the data without answers are meaningless too. Data and answers consistently all semester. That's the standard for this class. It should be the standard when you get to the real world. Make you better at what you do. Now, let's go back. I need to explain, oh, sorry, back to Bloomberg. I've got my screenshot. I talked about my economic sensitivity for the automobile industry and for Ford. I then go to RV. And I now do the I. The I is the industry. So I come over here to custom. I use my BIC's best fit algorithm or analyst curated if it has one. Choose one of the two. And then I take my template from homework 1, which is the ROIC for the industry. And it has the WAC for the industry. Just waiting for it to load. And we see that based on the global industry, the automobile industry has a slight positive spread. 10% WAC against 12% ROIC. Okay. Now, even though Ford's my company, when I do an industry analysis, the industry analysis is not on Ford, it's on the industry. The C analysis, competitive advantage, is on Ford. So the structure, the 5 forces, is explaining the 1188 versus the 10.03. It's not explaining the 2 versus the 5.77. Okay, so you're explaining the industry. So it's Ford and its peers. You must take a screenshot and submit as part of your homework assignment. Take a screenshot, save this. Must save ROIC and WAC. So you have 2 screenshots for your assignment. One of the industry beta with all the companies, the other one of the industry spread and all the company spreads. And you're going to use this screenshot to answer the question for the industry analysis, the industry spread, and for the company analysis, the company spread. Right now with the industry. So using the 5 forces model, we have to explain that positive spread. And it's not whether we think it's a good or bad industry. Right now, this industry is creating value. We had to explain why. Is it buyer power? Is it supplier power? Is it entry or exit barriers? Is it substitutes? Is it rivalry? Explain those 5 forces to the degree that explains the spread, covering all 5 forces. Now, I don't expect you to know a lot about all of these companies. So here's where you can get some additional information. You can go to BICO. In BICO, if the company has one, it will be the Bloomberg intelligence on the company. And this will be what the analysts are saying about the company. You can use this to help you with your analysis. Again, don't plagiarize. In this class, since we're dealing with real companies and real data, you can make references to those research reports, but you better have a bibliography, and or if you cut and paste, you better quote it. I had somebody last semester who cut and pasted a lot, went to the Honor Council and got an XF for the semester, right? Plagiarism is real easy to prove in this class, and it will be looked at extraordinarily harshly by the university. Do not plagiarize. Do not plagiarize somebody else's paper. Do not plagiarize a past paper. Do not plagiarize data from Bloomberg or any of these other sources. If you use another source, which you're going to have to do, make sure if you're quoting, there's a footnote. If there's not a footnote and you plagiarize, you are going to the Honor Council and you're not going to have any defense, right? Same thing with bibliographies. If you're using a lot of another source, cite it. That's acceptable. And that's going to be necessary for what you're going to have to do. So BICO is one of the areas. By the way, you can go to the industry primer and here's what they're saying about the industry. So a lot of the analysis for the 5 forces has been done by these analysts. You can read through this, curate it, and include that in your answer. But you got to talk about it in context of the 5 forces. Okay. So BICO and BI are 2 sources for getting the data to help you answer the question. Another source to answer the question for your homework and eventual group project is over here. Go back to on VBIC, which you can get to from our course homepage. Under industry, we subscribe to a data service called IBISWorld. IBISWorld writes 5 forces professional reports on industry. It's what they do. They do industry analysis and industry research reports. So it's perfectly acceptable to use an IBISWorld report. Again, source it or footnote it. But basically, you type in the company, in this case Ford, it'll tell you, Ford Motor Company, which industry reports it is part of. And then when you click on the report, it's loading it here. Okay. There's a benchmarking report, and then you can pick your industry. So I'll pick industry, car and automobile manufacturing. All right, so here is, sorry about the benchmarking report. Sorry, take this back. I want to get to industry research. There we go. Industry reports. So I find my industry, which I can also auto. All right, I'll do car and auto manufacturing in the US as an example. So here's my industry report for the US. And as I click through the data, here's what's going on at the industry level. SWOT analysis, industry structure. Basically, this is the 5 forces analysis. So as you go through this, you'll see that they've actually done a summary of the analysis of what's going on. So back to many of the companies you'll be working on this semester. You can use these research reports to help you write your analysis and understand what's going on. And then you're interpreting and putting in the 5 forces model to explain the industry structure, right? So let's say we're doing this. And what we see is a few things. So we see back to, so I'm writing up my paper. I reference my screenshot with a positive spread. And I talk about what's going on at the industry level. So for example, right now, the buyers don't seem to have as much power against the automobile companies. Automobile prices are spiking because of a lack of supply. So COVID has disrupted supply chains, which have made cars harder to find. And because there's been a lack of new car supply, prices have skyrocketed and buyers have less power. That's one of the short-term pressures that has helped the automobile industry. Okay. Same thing with suppliers. Suppliers are having challenges with supply chains. Okay. And because of the supply chains, input costs are going up. And so right now, suppliers are actually starting to put more pressure on the automobile industry, particularly the chip suppliers, because the automobile companies are scrambling just to get the supply that they can get. So right now, the suppliers are kind of hurting the automobile industry. It's not why they have a negative spread. It's putting a damper on the spread, but the buyer power is actually helping the industry because there's not as much buyer power. And it's also meaning there's less rivalry because there's fewer cars to go around. It's not that I'm fighting to basically sell cars versus other people selling cars, because I can sell every car that I have. Go to some of the new car lots, you'll see like 10 new cars on the entire lot. They have a lot less inventory than they used to. So don't need to have huge price competition in this environment. Okay. And so as you go through the forces, barriers to entry and exit are still very high in this industry. It's hard to become a global automobile company. Look at the struggles companies like Tesla have had to make money. It took them a decade before they could actually finally make money at scale. It's not an easy industry to get into or out of, right? And substitutes are not as viable yet for cars. We still drive, right? But nonetheless, we have to explain using these 5 forces, current profitability. And then what do we think is going to happen in 5 years? Are any of these forces going to change? So for example, I think the global supply chain is going to resolve itself. I think that the buyers are eventually going to have more power. If we go back to more normal times, there's a lot more cars in the market, and you're going to actually see more competition. That's going to put pressure on spread. Okay. So you have to come up with scenarios that are realistic and then tell me what's going to happen in the industry spread based on the industry scenarios by changing the power today versus 5 years. Clear on that part of the assignment, what you need to do? You're going to be doing it in Qualcomm. Great. Since I'm being crystal clear today, we'll then go to the third element. C, competition. Competitive advantage. Again, what we know from our reading in our textbook is competitive advantage transient. The best performing companies today, the fastest growing companies today are not likely to stay on that list 5 to 10 years from now. There's regression towards the mean. So the question is no longer do companies have competitive advantage? The question is how long? I was working with a company called Merck. They have a drug called Keytruda. Keytruda is the best-selling drug in the world by revenue. By 2025, it's going to almost be $30 billion per year of annual sales. It literally cures cancer, right? But it costs almost $100,000 a treatment. Very, very expensive drug. But here's the key. It's going to go off patent. And no matter how good that drug is performing, it's not going to be the best-selling drug in the world 10 to 15 years from now, because that patent's going to expire. And that patent expires, they're not going to be able to charge $100,000 for treatment. So the question is, how long is Merck going to do well before it doesn't? And so that's the point. Advantage is transient. Whatever your advantage is, it's eventually going to go away. How long before that happens? That's what we're going to try and assess when we do competitive advantage for a company. Okay? So back to, in the interest of time, your assignment. In this class, we are going to define competitive advantage as spread relative to peers. So if I go back to my forward list, in the I, we are going to submit the screenshot, and using the data on the screenshot, we were going to say that if Ford was my analysis, Ford was in an attractive industry because, and this is what I would have to write up, according to Bloomberg, the industry ROIC as of the latest filing, waiting for it to load here, was 11.88%, and the industry WACC was 10.03%, and that almost 2-point spread means that we're an attractive industry. That's what I would have to say in my I write-up, and then using the 5 forces, explain why and how that's going to change over time. Competitive advantage. What is my spread of the company I'm looking at versus the peers? Now, the industry has a positive spread of almost 2 points. Ford with an ROIC of 2 and a WACC of 5.77 has a negative spread. So any company that has a lower spread than the industry average spread, we're going to say lacks competitive advantage. So Ford clearly doesn't have competitive advantage. So that's what we'd have to say in the C part of our write-up for company. All right. And then we have to talk about why is Ford struggling? Got to explain, why is Ford having a negative spread? What's going on? And the final part of your write-up, is anything going to change in 5 years? Is Ford still going to have a negative spread in 5 years? And is Ford still going to have a below average to the industry spread in 5 years? That's the other part of our competitive advantage. So again, looking through the analyst reports, looking through Bloomberg, looking through research, giving your opinion, that's the other piece of your write-up. Okay, questions about the C and what that means and how we would do it. Use the same screenshot to refer to your C data as your I. So back to our homework assignment. Over here. By Monday, individual assignment. This is not a group assignment. Okay. You're going to perform an EIC analysis on Qualcomm, QCOM, US equity. You're going to use the analyst curated BI comp source. You're going to write a paper of a minimum 500 words. The TAs are going to open up your PDF or Word document and they're going to do a word count. And if the word count is less than 500, you're getting a 0. So make sure you write at least 500 words. They're also going to check for 2 screenshots. If you don't have the screenshots with the beta, RV markets beta, and the screenshot with the industry spread using the analyst curated BI for your comp source, you're getting a 0 on the assignment, no partial credit. So those 2 screenshots, that paper. Then you're going to write up the E, the I, and the C as described during today's class. Okay, you're going to talk about the economy, how sensitive it is, and you're going to talk about the beta, and you're going to use numbers. So again, if you use general, well, using the Ford as an example, the automobile industry has a positive spread. The automobile industry has a high beta. You're going to get a 0 because you didn't use any numbers referring to specific data in those screenshots to support what you're saying. So you're going to write up the E, you're going to write up the I. You're going to refer to the screenshot using numbers, and you're going to do a 5 forces explanation of the industry today. And you're going to do a 5 forces explanation of whether that's changing in 5 years. You're then going to talk about the company. Why does the company have a positive or negative spread relative to the industry? And is that going to change in 5 years? Basically, does it have competitive advantage? Again, you can use BI, BICO, ERC, or analyst reports, IBIS worlds through VBIC. Any of these can be used to help. Just don't plagiarize. Source and or quote, use footnotes. That's due Monday, 8 a.m., individual assignment, all sections. Questions about your homework assignment? You will have to use Bloomberg to do it. Any questions? All right, final thing I said I would mention today is the Bloomberg Trading Challenge. So on Monday, you're going to be a team captain. Take one of your team members on your list. They are going to basically have access to a part of Bloomberg that the rest of your team will not. Okay. And what it's going to basically do is they're going to have access to this. And I'll go to last semester as an example. So each of your teams, will start out with $1 million. There's 2 teams left over in here. Okay. And you're going to trade a portfolio over 6 months of pure equities. So for example, this team started out with $1 million. And if their portfolio was still running through today, it'd be worth $747,000. So they lost a couple $100,000 of their portfolio. They bought 14 stocks. These are the 14 stocks that they bought. Okay. Now, obviously, the market's been tough. They bought a bunch of stocks that have lost value. Okay. So that's the point. There's some minimum criteria for stocks that you can buy, but basically, you're going to start buying stocks on Monday. You're going to make equity trades, and you're going to be scored on portfolio return. Okay. And specifically, return overall for your portfolio value. Right. So by the end of the 6-week period, it's going to be a forced ranking. Team with the highest portfolio gets the best grade. Team with the lowest portfolio value gets the worst grade. You all start with $1 million of cash on Monday. Okay. The only person that's going to be able to trade on behalf of your team is using the Bloomberg terminal, is the person that you identify as your captain for the trading challenge. So as I said, make sure you know who that person is on Monday, because during Monday's class, I'm going to log them in and sign them up for the challenge and then turn them loose on your $1 million portfolio. And we'll spend more time on Monday talking about how those trades work. Okay, so that's what's coming up. If you have any other questions, which apparently you don't, TAs have office hours next 2 days. Make sure you turn in your next assignment by Monday. Recording of this class will be posted shortly. Have a good day, everybody.
Thank you.
Thank you. Have a good one.
You too.